When engineers are testing the limits of a massive structure like a suspension bridge or a skyscraper or something, they don't just look at the individual steel beams. They look for what they call structural exhaustion. It's this terrifying, totally invisible moment where the material itself just, it stops bouncing back, the stress becomes too much, and the entire framework starts to groan.
Yeah, that's a great way to put it.
And today, March 31st, 2026, if you are paying attention to the digital asset ecosystem, you are absolutely hearing that exact same groan.
You are. And it is a really profound sound if you actually understand the mechanics behind it.
Yeah.
Because we are looking at a market in a state of, well, deep structural dissonance.
Dissonance, yeah.
Exactly. Meaning the underlying machinery of the market is actively trying to process two completely opposing forces at the exact same time.
Like it's being ripped apart.
Yes. On one hand, it is aggressively pricing in the immediate, suffocating pain of restricted fiat liquidity. But on the other hand, it's trying to calculate the long-term fallout of these massive state-sponsored interventions in the global energy market.
Which brings us to the mission for this deep dive, because we are going to decode a massive real-time collision today.
I have a lot to get through.
We really do. We have a stack of raw on-chain data, forensic telemetry from decentralized prediction markets, Defense Department releases, and even a newly declassified white paper out of Google Quantum AI.
Yeah, that last one is huge.
It's massive. And we are taking all of this to figure out how localized corporate capitulation is crashing head-on into a historic sovereign energy panic. All while, a verified quantum computing threat just emerges at the base layer. So, okay, let's unpack this.
Where do we start?
Because this isn't just about red charts on a screen for you. This is about the fundamental pillars of the entire accumulation thesis literally cracking under stress.
Right. And to truly grasp this macro picture, we really have to start by looking at the absolute carnage happening in the microstructure of the market over the last 24 hours.
The localized pain.
Exactly. The broader geopolitical environment is the anchor, obviously, but the localized pain is what is driving the immediate price action you're seeing today.
Right. So let's talk about the micro trap, because if you were watching the charts today, you saw a totally brutal window where the asset just spiked.
It was violent.
It really was. It hit an exact intraday peak of $68,350. And for a second, it looked like a clean breakout.
But then it wasn't.
No, it was violently rejected. Swept all the way down to a trough of $65,740 before, settling into this incredibly fragile baseline near $66,600. What actually happened under the hood there?
Well, the mechanics behind that rejection illustrate exactly how predatory automated market makers can be. I mean, this was a mathematically precise bull trap.
A bull trap. Okay, explain that.
So when the price surged toward that 68,000 mark, a massive wave of retail and tactical traders just jumped in. They took on leveraged long positions.
Hoping for a ride up.
Right. They looked at the price action and assumed, a momentum breakout was underway.
Right.
But the institutional algorithms operating in the background, they don't just look at price.
What are they looking at?
They look at underlying demand telemetry. Specifically, they were monitoring the Coinbase Premium Index.
Okay, and for anyone who doesn't track that daily, the Coinbase Premium essentially measures the price difference between Coinbase Pro and offshore exchanges like Binance, right?
Right.
It tells us if actual institutional U.S. buyers are stepping in or if it's just, offshore leverage pushing the price around.
And that is the crucial distinction here, because the algorithm saw that the Coinbase Premium was entirely negative.
Oh, wow. Entirely negative.
Yes. There was no real macroeconomic conviction behind the rally at all. No fundamental spot buying. So the automated market makers, they recognized the trap.
And they pounced.
They did. They aggressively dumped their own spot inventory onto those late overextended tactical longs. And the moment the buying momentum evaporated, those algorithms just pulled their passive bids.
Meaning the safety net was gone.
Exactly. The order books instantly thinned out, and the price just fell through the floor. It triggered a cascading wave of stop-loss orders.
And the scale of that cascade is just staggering. I mean, looking at the liquidation data, we are talking about $150 million wiped out in a single 24-hour cycle.
It's brutal.
Over 78,000 individual trading accounts completely liquidated, just gone. And nearly 60% of those liquidations, about $89.3 million, were long positions, people betting on a rally that simply didn't exist.
Right.
But here is where I get hung up. In a healthy market, when the price drops that fast, value buyers usually step in. So why was the order book so empty? Why was there absolutely zero defensive liquidity to catch the market?
Well, it's because the corporate treasury thesis.
The idea that public companies would just act as the ultimate buyers of last resort.
Exactly. That thesis is actively collapsing under the weight of traditional debt. And we saw the definitive proof of this today with Nakamoto Holdings, trading under the ticker NAKE.
This is the part of the data that really blew my mind. Because Nakamoto Holdings just dumped 284 Bitcoin directly onto the open market. And they did it to raise exactly $20 million in fiat just to cover their operational needs. This is right after they went on that aggressive acquisition spree, buying up BTC Inc. and UTXO Management.
The timing is terrible.
It really is. It feels like taking out a payday loan to buy a mansion at the absolute top of a housing bubble, and then, having to sell your furniture at a yard sale just to keep the lights on.
That analogy is mathematically perfect, honestly, because the math on their filings confirms it. Nakamoto's weighted average acquisition cost for that specific tranche of Bitcoin was $118,171 per coin.
Good grief.
Right. So when they were forced to sell those 284 coins into a totally illiquid market just to get that $20 million, they unloaded them at roughly $70,422.
Wait, so they swallowed a 40% realized loss?
Yes. They had absolutely no choice. I mean, they are currently suffocating under a $210 million USDT loan from Kraken.
And what's the interest rate on that?
That carries an 8% interest rate.
Wow.
So the interest payments alone are just draining their fiat reserves. It's forcing them to liquidate their digital treasury just to service the debt on the very asset they were trying to accumulate in the first place.
It's the absolute worst-case scenario for debt-fueled accumulation. And what makes it so terrifying, honestly, is the silence from the rest of the market. Because the apex predator of this entire space, MicroStrategy, has gone completely quiet.
It's true. The data shows that.
Yeah, for the first time in over 13 weeks, they have paused their weekly accumulation.
And that matters. Because when that systematic billions of dollars purchasing power halts, the balance of power immediately shifts to the sell side.
Because there's no floor anymore.
Exactly. MicroStrategy's predictable buying was essentially the structural floor for this asset. Without it, distressed sellers like Nakamoto get to dictate the price.
But wait, I have to push back a little here. Because if you are sitting at home watching your portfolio bleed out, you might be looking at the exchange-traded funds for some kind of hope.
Sure.
And the ETF data for today actually showed a $69.4 million positive inflow. You had ARKB bringing in $33 million, BlackRock's IBIT pulled in about $7.5 million. So why didn't that institutional inflow stop the bleeding? Isn't a green day for the ETFs a bullish signal?
You really have to separate passive low-conviction flows from active high-conviction distribution.
Okay, unpack that.
Well, yes, $69 million is technically a positive prep, but look at the scale of it. It barely makes a dent in the previous week's catastrophic outflow, which totaled $296 million.
Oh, right, a drop in the bucket.
Exactly. And more importantly, ETF inflows are passive.
Yeah.
They drip into the market slowly over the entire trading day.
While Nakamoto was dumping all at once.
Yes. Nakamoto's selling was active and it was urgent. That $69 million in passive institutional inflow is entirely neutralized when a distressed corporate entity dumps $20 million worth of market sell orders into a thin order book in just minutes.
So the passive lifeboats just can't handle the active volume of the sinking ship.
Basically, yeah.
And this brings us to the core of the issue. The reason borrowing costs are crushing these companies, the reason a firm like Nakamoto is choking on an 8% loan in the first place, is because fiat liquidity is structurally restricted across the entire global economy.
Which is the macro anchor here.
Exactly, the macro anchor of this deep dive. Why is money so tight? Because the global energy matrix is literally fracturing.
Right. And the localized pain we are seeing in digital assets is completely subordinate to the physical reality of the global supply chain.
The real world is intervening.
Very much so. The Iranian military apparatus has effectively closed the Strait of Hormuz. Consequently, we are watching Brent crude oil violently breach the $116 to $120 per barrel threshold.
And sovereign nations are hitting the panic button. I mean, the G7 and the International Energy Agency just deployed a historic release from their strategic reserves. They authorized 400 million barrels of crude.
a massive number on paper.
Right. You have 172.2 million coming from the US, 79.8 million from Japan. But let me do the math for you here, because this is where the narrative completely falls apart.
It doesn't add up.
No. The global economy consumes roughly 100 million barrels of oil every single day. So the largest coordinated emergency release in global history covers exactly 4 days of global demand.
It is a mathematical illusion. It's designed to artificially suppress an inflationary shock. But the data indicates that the diplomatic channels know it failed.
How do we know that?
Because that 400 million barrel release already happened earlier this month. And the price of oil didn't stabilize. So the G7 is, right now, as of today, actively preparing a second coordinated release.
Wow.
They are draining finite national security assets to fight a fire that is mathematically out of their control.
And that fire is turning kinetic. If you look at the releases from the United States War Department, Secretary Pete Hegseth and General Dan Kane just announced Operation Epic Fury.
And that's not a containment strategy.
Not at all. The stated objective isn't just containment or keeping the shipping lanes open. It is the total, systematic eradication of the Iranian military and defense industrial base.
And this escalation is already manifesting in physical reality. I mean, just today, an Iranian suicide drone struck a Kuwaiti oil tanker right off the coast of Dubai.
Right off the coast.
Yeah. They're penetrating supposedly secure Allied airspace, which proves that the energy transit corridors are fundamentally compromised.
Okay, here's where it gets really interesting. Because while the Pentagon is executing total war and, tankers are burning off the coast of Dubai, President Trump is taking to social media.
Tweeting through it.
Yeah, actively tweeting about an imminent diplomatic ceasefire. He's clearly making a desperate bid to suppress oil prices and calm the traditional markets. But if you look at the blockchain, someone is calling his bluff.
They are. The forensic telemetry on Polymarket, the decentralized prediction platform, it reveals a severe informational asymmetry.
What are we seeing there?
We are seeing highly sophisticated anonymous wallet splitting.
Let's explain how that works for a second. Because how do we know this isn't just, a wealthy retail trader taking a massive gamble on a ceasefire?
Because of the execution methodology. A retail trader just hits the buy button. What we are seeing here is a technique similar to smurfing in traditional finance.
Smurfing, right.
Right. Dozens of fresh, totally unaffiliated wallets are deploying exactly $70,000 each. And they're doing it in staggered, timed bets on an immediate April 6 ceasefire.
So they are hiding their tracks.
Exactly. They are intentionally breaking up a massive position to avoid triggering automated price alarms on the prediction market. And here's the kicker. The quantitative behavioral signatures of these specific wallets perfectly match the entities that executed massive insider trades right before the February 28 strikes.
Oh, wow. So we are looking at someone with highly classified geopolitical knowledge, essentially front-running global history on a public ledger.
That's exactly what it is.
They know the ceasefire is real, and they are positioning for it before the traditional markets can react. But let's bring this back to the portfolio level. If you're an allocator sitting at a desk trying to manage risk today, what does $120 oil actually mean for your digital assets?
It shifts the entire fiduciary calculus. The literal math asset managers use to justify holding an asset has fundamentally changed. Because oil is at $120 a barrel, inflation is mathematically guaranteed to remain sticky.
It's baked in.
Yes. Therefore, expectations for the June FOMC meeting have violently flipped. The market is no longer pricing in rate cuts. It is actively pricing in rate hikes to fight this upstream inflation.
And when interest rates stay punishingly high, capital flows out of risk assets and into guaranteed yield.
Exactly. It guarantees sustained, relentless valuation compression for zero-yield assets. And that is the macro anchor explaining why the quantitative algorithms were so eager to dump their holdings on retail traders in that bull trap we talked about earlier.
They saw it coming.
They are deleveraging in anticipation of a prolonged high-rate environment.
It's a brutal, closed-loop system. The energy shock drives inflation. Inflation keeps interest rates high. High rates crush the corporate treasuries who bought at the top using leverage. And then their forced liquidations crash the secondary market.
It all connected.
It really is. But while the fiduciaries are panicked about oil and interest rates, an existential earthquake just went off at the foundational cryptographic layer of the ecosystem.
Yes, and this fundamentally alters the long-term viability of the network. A landmark white paper was just published by Google Quantum AI authored by Ryan Babouche and Hartmut Nevin.
The absolute heavyweights in the quantum field. But I have to admit, I get a little lost in the physics here. I know quantum computers are incredibly fast, but why are they an existential threat to this specific ecosystem? Like, why can't a regular supercomputer do the same damage?
It comes down to how they actually solve problems. Think of it this way. A traditional supercomputer tries to pick a lock by brute force. It tries every single key combination one by one.
Which takes forever.
Right. Even the fastest supercomputer would take millions of years to guess the private key to a wallet. But a quantum computer doesn't guess. Using principles of quantum superposition, it essentially looks at the lock and calculates the exact mathematical shape of the key almost instantly. It bypasses the guessing entirely.
And the Google team proved they can do this.
They utilized advanced zero-knowledge proofs to demonstrate the capability. They needed to definitively prove to the cryptographic community that a catastrophic vulnerability exists, but they had to do it without giving malicious actors the actual roadmap to exploit it.
That's a tightrope walk.
Very much so. But they proved that future quantum computing architectures can break elliptic curve cryptography, or ECC, vastly faster than any historical model estimated.
And ECC is the foundational mathematical lock that secures every single Bitcoin and Ethereum private key.
That's right.
So this isn't theoretical anymore, it's verified by Google, which means the entire network now has an execution risk hanging over its head. The entire digital asset space must undergo a highly complex, network-wide hard fork to integrate post-quantum cryptography.
It's going to be massive.
I look at it this way. We are essentially being forced to replace the engines of a commercial jet mid-flight, right, while flying through a Category 5 geopolitical hurricane.
It is an unprecedented engineering mandate. But what is truly fascinating is the dichotomy between this base layer vulnerability and the rapid expansion of the secondary access layer.
What do you mean?
Well, while the core cryptography faces an existential threat, the institutional plumbing, the actual onboarding rails for sovereign capital, is expanding and formalizing at an aggressive rate.
Right. While the engineers are sweating the quantum math, the traditional finance sector is actively laying new pipe. Like today, HashKey Mana officially launched HashKey Pro in Dubai.
Yes.
And their big selling point is offering fully regulated omnibus accounts. What does that actually change for the plumbing of this market?
Well, imagine a traditional Tier 1 bank wanting to offer digital assets to its sovereign clients. Previously, they had to deal with retail exchanges, which carry massive counterparty risk and, frankly, regulatory uncertainty.
Nobody wants that risk.
Exactly. An omnibus account changes that entirely. It is a single, heavily regulated master account. The bank holds the master key, and they sub-allocate the assets to thousands of their own clients internally on their own ledgers.
So it's completely opaque to the outside.
Yes. The public blockchain and the broader market only sees one massive institutional actor. It completely insulates institutional and sovereign wealth from the chaos and volatility of the retail market.
And Dubai isn't the only jurisdiction building this out. Traxel just announced they are structuring a massive stablecoin and fintech infrastructure platform around Ibexial in Paris.
Right, in Paris.
They are explicitly designing it to separate the underlying technology layer from the regulated financial flows. The irony here is just incredible.
It really is.
Just as the base layer cryptography faces its most severe verified threat in history from Google Quantum AI, jurisdictions outside the United States are rapidly building the exact institutional architecture needed to onboard sovereign wealth. Wealth that is, desperately trying to escape a failing fiat paradigm driven by the energy shock in the Strait of Hormuz.
Synthesizing all of these data points, the reality of the ecosystem today is that it is trapped in a massive compression zone.
A compression zone.
Yeah. You have corporate treasuries, like Nakamoto, completely capitulating under the weight of fiat debt and high interest rates. You have a macro environment that is being suffocated by $120 oil and kinetic multi-domain warfare.
And the tech itself is under threat.
Right. The core technology is facing a mandated high-wire quantum evolution.
Yeah.
Yet beneath all of that algorithmic volatility and liquidation carnage, the institutional rails for a massive sovereign rotation are now fully operational.
So what does this all mean for you? Think about those sovereign wealth funds in the Gulf right now. They are staring at the Strait of Hormuz crisis literally in their own backyard.
For row seats.
Yeah. They are watching the global energy transit system fracture, and simultaneously they are building massive regulated omnibus crypto infrastructure in Dubai. All of this is happening exactly as the over-leveraged retail traders and proxy corporate firms in the West are getting violently washed out of the market.
The timing is suspicious.
It leaves you wondering if this violent leverage flush is actually the prerequisite phase, making room for true state-level sovereign accumulation to begin.
It certainly clears the deck.
It really does. But I want to leave you with one final thought to mull over. We talked about Google proving that quantum computers can break elliptic curve cryptography. Right now, we view that as a technical hurdle that the developers just need to patch with a hard fork.
Like a software update.
Exactly. But what if sovereign nations realize that whoever breaks ECC first doesn't just crash the market? They gain the ability to unlock any wallet on the network. As these nations build massive omnibus accounts to hold billions in sovereign wealth, are we about to see quantum computing transition from a Google research project into a covert state-level arms race for the ultimate financial weapon? Think about that the next time you look at the charts.